Good evening, everyone. Thanks to all of you for coming today in all this traffic. So we have our speaker here, Mr. Nikhil Vora. I'll just be giving him a brief introduction, not that he needs one to this audience. So it's an absolute honor to welcome Nikhil Vora, our distinguished guest. He's the founder and CEO of Sixth Sense Ventures. So he has a overall experience of 28 years in financial markets, and he's regarded as one of the best consumer sector minds in the country. Before founding Sixth Sense Ventures, he was the managing director and head of research at IDFC Securities, where his insights were highly sought after by global investment giants like Capital, Fidelity, Bernstein, etc. His exceptional analytical skills earned him the title of India's best analyst in the Asia Money polls and Asia's best analyst by Wall Street Journal in 2012. Beyond his expertise in financial markets, Mr. Vora has played a pivotal role in shaping strategies for some of India's largest companies, including Nestlé, HUL, Marico, Godrej, and Aditya Birla Group. As an active angel investor, he has been amongst the first to back transformative businesses such as PayTm, Fog, Purple, Incred, and many others. A postgraduate in management and an alumnus of the Future Leaders program at the University of Oxford, Mr. Vora's contribution to the business world have been recognized by the Thought Leadership Award by IDFC Group. Today, we have the privilege of hearing from a visionary who has not only shaped markets, but also has built some of India's most successful consumer brands. Please join me in welcoming Mr. Vora with a huge round of applause. Over to you, sir.
Thanks so much. I really don't know how much, Varun, what you said is really true, but anyway. What is not true is that it's not 28 years, it's 32 years, like 60 years, but yeah. Okay. Firstly, many thanks for having me here. Rajesh is a dear friend and who invited me, and Varun's obviously been following up. So thanks so much, Varun, for having me here. I was just sharing with them that I'm a social recluse. I'm not necessarily the best guy to socialize, but I'm very, very happy to go to institutions and so on. So I do it at IITs, IIMs, and my kids' schools and so on. So that's fine for me to do. But I can't really socialize so much. So good to be here with potentially aspiring financial professionals and so on. What I would do is, while there is a presentation, so that will go on at the back end, I'll maybe share the journey of Sixth Sense because it is pretty much the consumer code as possibly has been laid out. It's how, with our biases, obviously, how I see consumer businesses going forward, how I see consumer behavior trends shape up. What do I think can happen in this space, which I'm sure all of us relate to in some form or the other over the next few years and so on. And very happy to take questions, or please interrupt me wherever you want and so on. So, yeah. Just to share a bit about where we are. Okay, let this move on. So I'm Nikhil Vora. I'm the founder, CEO of Sixth Sense Ventures, which is India's first and now India's largest consumer venture fund. We manage close to 5,000 crores of domestic capital. So it's the largest INR fund in India, which is non-grandfathered. So we are not a Sequoia subsidiary or a Kotak subsidiary and so on. So it's khud ki dukaan. So it's done well in its own regard. Sixth Sense is also 11 years old now, so it's my entrepreneurial journey. I've been a professional for over 2 decades prior to setting up Sixth Sense. Prior to Sixth Sense, I was the managing director, head of research at IDFC, where ironically the fiduciary responsibility was always about advising clients in India, abroad, about listed market, public market. So I've been a public market guy for 20 years. However, when I wanted to set up my own shop, it happens to be in the venture stage. So I'm hoping and believing there was a fair bit of thought why venture in India will be a lot more relevant over the next couple of decades than what public market is. And I've done decently well in public market as a professional. So I was invited by global boards of Unilever, global board of Nestlé, by Adi Godrej, Ashmariola, and so on, to make a pitch about what I think their businesses need to do in India over the next decade. Very interesting and satisfying because, as you know, these are corporates which have lived the course globally and in India for 100 years plus. And by default, they are fairly allergic to external opinion, and rightly so. They are supposed to know what's right and wrong for them to do. But they like the critical evaluation which one did about how one saw consumer behavior patterns emerge over the next decade, and thereby how businesses will need to morph and change today to be relevant for that consumer tomorrow. So quite interesting, relevant, very critical also. Just to share how critical it was, I had in my presentation to Unilever, and that time Vindi Banga was the CEO of Unilever, and he was just moved up. And I'd actually said it in the presentation that Vindi should have been moved out, and he's been moved up. Yes, and Vindi was the India CEO for 5 years. He became the number 2 guy in Unilever globally. So fundamentally, and my thought was that for 5 years, Vindi did not change the direction of Unilever in India. And fundamentally, it's incompetence is the wrong word, but he had obviously not done much technically. So to me, it actually showed how poor the performance management yardstick in Unilever was for someone who did not deliver to be moved up rather than being moved out. I'd also, during that same time, talked about the fact that someone like Nitin Paranjpe, who eventually became Unilever CEO, should be made CEO. And this is around 2-3 years before Nitin became CEO. That if Nitin is the rock star, the system should help the guy who's an outlier to become a CEO rather than. So I think it was quite interesting. It's still regarded quite nicely in the Unilever system across the board and so on. Along the way, also got accorded as India's best analyst by Asia Money, Asia's best analyst by Wall Street Journal, which is not like Filmfare Awards. Not everyone gets it, so it's good. Okay, I'm just kidding, but anyway. But yeah, the idea is that why did I, and I think that would also possibly go with the consumer code that we're looking at. Firstly, why was Sixth Sense the first consumer fund in India in 2014 when I moved out of IDFC and set up shop? And secondly, why a venture fund for someone who's been in public market for 20 years and did a decently okay job at that? So one was, I've always been a person who's very driven by anecdotal references. So if you look at Fortune 500 in 1980s and look at the same names today, 90% of Fortune 500 companies have died or become irrelevant over decadal cycle. And it's quite strange because these are by far the best endowed companies in the world in terms of management, scale, capability, execution, capital, revenues, profits. Everything is just about perfect. That's why they're in Fortune 500, and yet 90% of them die. And none of them die because of competition. It's always said that the known very rarely kills you, it's the unknown which kills you. And the unknown, in this case, to me, was about change in trends. Fundamentally, leaders have this leader's curse or success curse, which becomes difficult for them to disrupt themselves to be relevant for what will happen in the next decadal cycle and so on. So very, very few guys actually outlive the cycle. And to me, the listed market in India was very symbolic of Fortune 500. These are also the best endowed companies, fairly decent management, well capitalized, but they'll go the Fortune 500 way, which means that over a decadal cycle, they'll become less relevant and less dominant to what they are today. And fundamentally, investing principle is only one. You can strip off all the imagery around, but it's only one investing principle, which is investing in leaders of tomorrow. For investors, for businesses, all of us who might be running some businesses, fundamentally you need to run a business which is relevant for tomorrow. Yeah, if it's investing is about investing in businesses of tomorrow, then they are getting born today, and thereby they are going to be private. So that notion of why private will make sense in India was getting quite, I think, frozen in my mind before I set up Sixth Sense. So that was the reason for looking at venture and not at public market. Second is obviously, done fair bit of, while I was in IDFC, which was a late stage investor in India, we had the flex to do early stage investing on our own if we wanted to. So I ended up being one of the first investors in companies like PayTm, Vini Cosmetics. I'm sharing this only because, frankly, I think it's good that you guys know this. I'm not trying to be pompous, please. I genuinely want that you guys take away at least few things and how possibly the evolution cycle has been for someone. So PayTm, Vini Cosmetics, Purple, BVG Limited, which is now India's largest facilities management company. They clean up Rashtrapati Bhavan, they clean up Indian Railways, they operate the one-way ambulance network that you see in India and so on. Kangaroo Kid Billabong High, which is one of the finest educational networks in India. So a lot of these businesses did very well. And obviously because I was the first investor in most of them, the outcomes have been extremely non-linear. So for instance, again, I can share this. I'd invested in Purple, which is a Nika equivalent, at 10 crore equity value. I was the first investor. I had put in 1 crore at that point. And 2007, 2010, frankly, there was not so much of angel investing in vogue. It's become so relevant now. Now I'm sure all of us do some bit of angel investing in some form. At that point, it was very, very limited in India. So I'd invested at 10 crore equity value. The latest round of Purple has happened at 10,000 crores. That's the value of the business right now. So that 1 crore is worth 200 crores or plus, something like that. I continue to remain invested right now. PayTm, obviously, I was the first investor. Again, not first investor, I was a very early investor. PayTm was not even born that time. It was 197, which was doing some very boring, non-seductive collaring back tunes. So PayTm was not even born. But love the fact that Vijay said that, so it met up and he said that he's planning to create a mobile app, a payment app on the mobile. And I found that very, very interesting. And frankly, investing as you all will grow further into this, try to, and maybe it's different for everyone, but try to limit your consideration set to 3 things. Don't go to 300 variables. You'll never get it right. So in this case, Vijay saying that he wants to create a mobile app, a wallet on the mobile was, I think, very interesting. In my optic mind, I was saying that, okay, India will become the largest mobile pop in the world, which it is true today. This is in 2012, 11, 12, which is true today. The second is that if you're a wallet on a mobile, you're fundamentally capturing the most expensive real estate in the world. So if there are maybe 100 odd people out here, I'm sure all of us have maybe 5 apps which are common. We'll have our Swiggy, Zola's, Zomato, and so on. All of them are worth a few $1 billion. So anything which captures the most expensive real estate in the world has to be very expensive. So that was the optic thought when I had invested, and that's so true as you move forward, right? So I think the investing that one did gave you a sense of saying that, okay, it actually makes a lot of sense. It's about investing in disruptive founders who are cracking the code, and the outcomes can be very, very non-linear, both as a business and obviously as an investment that you look at. So obviously that got you gravitated towards venture and private businesses. On the consumer side, it's very interesting. India is a very, very strange animal in consumer. So if you look across all spaces in India, everything has changed more, everything has really moved in a different direction, right? Financial services has moved and so on. Everything has changed quite considerably. Consumers was only one sector which had not changed at all. It had not morphed at all. So there were 15 companies in India which used to control around 70% of wallet share in 1980s. There are 15 companies in 2010 which were controlling 65% of wallet share, which fundamentally meant that there was no new disruptor in consumers for the last 4-5 decades. Yeah, which means that wallet share means that whatever we were spending, 70% was going to the same 15 companies in India, right? And again, there's a very strange phenomenon in India where 2 companies control almost 80 to 100% category share in almost every category that you look at, which is bizarre. India, we all are used to saying that India is like 30 countries put together, right? 30 states and so on. And everyone has a different taste, preference, and so on. Not true at all. 2 companies control 80 to 100% category share in almost every category that you look at. Feminine hygiene, oral care, personal care, beverages, everything was extremely duopolized in India. Yeah. And my, again, optic thought was that this duopolization was not because the brands were super powerful. Normally, extreme duopolization or monopolies happen because there is an IP attached to that product. But there's no IP attached to a Dove. I can make a Dove as good as Unilever does it. There is no Intel inside a Colgate. You could make a Colgate as good as Colgate does it. So there's no IP attached to the business, to the product. But yet all of us were consuming the same product again and again. Fundamentally, there was a belief that the brands are powerful. It's not true. The brands were not powerful. It's distribution which was a bigger moat which was created. And thereby, anyone who cracked that distribution fundamentally sold everything that they wanted to. So if I had a better product than Dove, I could not put the product on shelf because Unilever would knock me off the shelf, right? So there's no ability of anyone disrupting an existing player. Again, the belief was that in India, distribution will get democratized over a period of time. This is before setting up 6sense. So the reason why 6sense was set up. Felt that regional, third-party, digital, e-com, and now quick-com will happen, and that will change the course of distribution landscape in India. And thereby the emergence of lot many brands, lot many companies who will challenge legacy players. And this is true worldwide. Worldwide, extreme duopolies are not more than 40-45% category share. India was 80 to 100%. So clearly that needed to break. Second, it was also coming at a time when brand loyalty, and I have this as a favorite quote for mine, brand loyalty is at an all-time low, brand awareness is at an all-time high, which is a great case for disruption to happen. What does it mean? So if, let's say, my daughter, she's 19 years, if she drinks, so all of us have been drinking Kingfisher, assuming that. But if my daughter, if she drinks, when she drinks, I hope she doesn't, she'll not drink Kingfisher. Yeah, they passed that generational curve. So clearly, legacy businesses will find it a struggle. Like if all of us have been Titan wearers, the only way of growing out of a Titan is to either not wear a watch or to wear a Swiss watch. That's the only option. Yeah, so you outgrow legacy very fast. The strongest brands in the world, Coke and Pepsi, are to me the most slippery brand franchise in India. Maybe true in the world, but so much so true in India. So clearly that was one other layer that one thought about and so on. And thereby the ability of businesses, companies to disrupt legacy guys and so on. And like I said, fundamentally we have to invest in leaders of tomorrow. And if they are going to be leaders of tomorrow, they're getting born today and they'll be private. So consumer businesses on. We've come a long way now from that journey. We've done decently well. We manage, like I said, 5,000 crores of domestic capital. We've managed 3 funds so far. Both our first and second fund, which are completely invested, are in the top 5 in India across the last decade, across any life cycle fund. Right from an angel fund like a Bloom, for instance, to a deep private equity fund like a KKR. So it's done very well in its own regard. So it's a nice journey to be at. But like a lot of things that we all do, we have to differentiate what we do. One is obviously the performance. Second is also about what you should stand for. So when we set up Sixth Sense, there was clearly the 2 missions that we had. One was operational and one was non-operational. Operational was about investing in the consumer of tomorrow today, which is invest wherever we think the wallet share will go over the next decade, invest early in the journey of those businesses. And second was non-operational, but I think the most potent one, which was about creating the most credible venture fund in India. I think that was it, creating the most credible venture fund. And what we did towards that is, one is obviously delivering whatever we need to and so on. That's our fiduciary job. But second was, we did India's first and possibly the world's first, a 0% management fee structure. Again, I'm sharing this so that maybe you can pick up some insights and use it in some other form. So everywhere in the world, the economics of running a PE VC fund is the same. Be it in India, Australia, Europe, US. It's 220. 2% management fee, 20% carry. That's a broad economic structure of running a fund. I've been very clear in my mind when we launched it that any business in the world, if you make a bad product, you get penalized. And rightly so, that's the way it should be. If you make a bad product, you should get penalized. Fund management was the only business in the world where fund managers never got penalized for a bad outcome. So it didn't matter. It didn't matter to any fund if the fund didn't deliver. Yeah. We are very clear that we'll not make monies like this. So today, what it means is, so we have a 0-20 structure, 0% management fee, 20% carry, or 3% management fee and 0 carry. That's the 2 economic structure that we have. Any investors can choose which option they want and so on. Why it's important is that what it means is that if today we are managing 5,000 crores of capital, technically, we are leaving 800 crores on the table, which we would get even if the fund did nothing. Yeah, 2% management fee, 5,000 crores, 100 crores per year, let's assume 8-year fund, 800 crores, is what we would get as Sixth Sense. We're saying we don't want to make that money. Yeah? So I think that's a big statement to make, big intent. We will make a lot of money also, but we'll make money if we deliver money to our investors and so on. So that's the objective and so on. Okay, just on, okay, I'll just put it. Just the way I see consumer trends happening and why disruption in India with legacy business will become so much more real. One is obviously the macros that all of us know. One is India possibly will become close to $4.5 trillion market in consumption in the next 4-5 years, growing very strongly. Indian GDP per capita has grown extremely sharp in the last 20 years. It's grown 5x. Comparatively, US has grown 2x, right? So Indian per capita GDP consumption is growing. The interesting part to me is, if you look at the Indian pyramid, which all of us have learned to live with, The bottom end of the pyramid, which is the poor consuming class, but relatively poor consuming class, which is fundamentally the unorganized, unbranded, regional, and so on, and someone who, is very price-sensitive market, used to be more than 1/3 of India. Was 43%. Yeah, that has become 13%, and this is in 1.5 decades, less than 1.5 decade. It's become 13% right now. The mid to top end class, which is luxury, is now 51%. It used to be 24% odd, so it's more than doubled. Now, what does it mean? And one can debate whether these numbers are real or no, because I'm sure statistics can be anywhere. But what it really means is that the entire Indian consumer companies or businesses were fundamentally catering to this entire low and low mid income, because that's where the market resided, right? So they were all general trade dominated. Everyone's product, pricing, attributes were all for the low to mid income consumer. No one had anything at the mid to the top end, right? The irony is that the country is moved mid-premium. Legacy businesses are still there. So for them to address this entire consumer need of the top-end market is going to be a huge, huge challenge. It's like Maruti trying to sell, let's say, a car at 30 lakhs or 40 lakhs. Just almost impossible, yeah? Because they've just got themselves so glued onto a price point which they will find it very tough to change. So I think that's a big change, and that's where disruption in India will become so much more dominant and real. All of us in the investing world will keep thinking of this, that this $2,500 USD per capita income will possibly move to 4,000 very, very shortly. That incremental capital that you look at gives birth to a completely different consumer, which is a huge one, and that's where legacy businesses are not there. We were just chatting up just before that there is a slowdown in India, and people talk about slowdown. I'm not a believer of that at all. I think our spends have increased, our savings have actually decreased, our incomes have increased. So and our spends have gone into different directions, right? So it's not that consumption spends have decreased. Consumption spends for legacy companies have decreased because relatively they are trying to attack a market which is fully penetrated. They're still catering to the consumer of yesterday. Consumers moved forward. Yeah. Obviously, these are attributable changes that one looks at, which is obviously the income effect and then goes down as you go up the ladder. And this, I'm sure, a lot of us will be able to relate to and so on. This is what I was sharing, that it's interesting. Almost every category that you look at in India is so duopolized in its own nature, which is almost a sitting duck. These trends are not visible every day. You'll not see it happening in 3 months, 6 months, 2 years, and so on. It happens over a decadal cycle. But whenever it happens, it becomes a very drastic impact to look at, right? Think of it. We all thought e-commerce is the next big thing in life, and suddenly in 2 years, quick com has almost killed e-com. At least I would want to believe that. Yeah, e-com is still very, very large, but I'm still making a statement that e-com is actually dying. Yeah, instant gratification for all of us is so large that even Amazon Prime has become passé. You don't want to wait next day; you'll do it now. QuickCom will figure out how to even deliver like they do, right? Durable also if required in 30 minutes, and they figured it out. So I think the trend change, when it happens, it becomes very, very drastic. The early moves are baby moves, and then it becomes very, very non-linear. And it's getting accompanied by how media was also changing. So again, 10 years back, and it's not too far, 10, 15 years back, media, which is equivalent to consumption, because that's how companies have spent capital and got consumers, was 100% between print and broadcast. I remember it used to be like 50%, 55% print, 55% broadcast, 40% print, and 5% radio. That used to be the outdoors and so on. Today, more than 50% of the advertising budget, and it's in last 10 years, has moved away from print and broadcast. All of us, and I'm sure this is a sample to look at, all of us now watch time-shifted television. 10 years back, we would or 5 years back maybe, we would still watch a program at 9 o'clock on a broadcast network. I'm not too sure anyone does that anymore. Yeah. So, and there's something which, as an analyst, as a research guy, I had done some work almost 15, 17 years back. US at that point was watching, 60% of US was watching time-shifted television almost 15 years back. So true now. And that time we said, this means broadcast will die. So true today. So I think it's very important to also optically visualize what you think a business can do and so on. So pretty much true. And that also gives birth to different distribution channels, right? So you can segment it out almost and see how it's all changed. So this is interesting. Some of the, these are just case examples to look at, but like I always tell founders, and obviously when we are looking at investing, I think the best, beyond the founder, obviously, whatever, I think the best space to invest in is any space which is extremely monopolized or duopolized. I think it's a super sexy space to invest in. So if I look at Gillette, male grooming space, almost 100% market share. Yeah, there used to be Topaz earlier, House of Molotovs, which has died, so it's only Gillette technically. And there is Veet, which is a hair removal cream for women, which is Ricket. It's again almost 100% category share. Now, two companies control 100% category share into categories which are not necessarily rocket science. Hair removal cream is not rocket science by any stretch. Gillette controlled the market despite being the premium product that all of us know of. Suddenly you had a Bombay Shaving, which is one of our portfolio companies. Bombay Shaving, which came in and said that, okay, I know how to make a product which is equivalent to Gillette, if not better. And I know how to compete against Veet. Crack that code. Distribution loves challengers. Distribution hates the existing legacy winners, yeah? Because they can get more out of the guy who owns 80% category share by squeezing the guy, by letting someone take 5% category share or 10% category share. So distribution always hates leaders, yeah? Because they can squeeze out more from them by getting someone else to replace them. And this is also an indication about how channels change. Earlier, Unilever used to operate in 12 million retail outlets. Let's assume that's the universe of Indian consumer business, right? So 12 million retail outlets. So fundamentally, you could never compete with Unilever because there's no chance that you'll even get 10% of the Unilever market because it's just so difficult. Now, if I want to compete with Unilever, I don't need to have a single distribution GT outlet. I need to crack 15 distribution house. So I need to crack Zepto, Blinkit, Insta. I need to crack Amazon, Flipkart. Need to crack Reliance, DMart, and so on. If I crack these 10, 15 large distribution houses, I will actually reach out to 15 to 20% of the consumer base. So I don't need my offline distribution to be at that 20 million. It would be 12 million. It would be great if you can crack that, but you don't need to do it in the first 5 years of your life, which means your ability to actually outshout, survive, and grow is a lot better than what you ever had before in India. And it also shows how new age brands start to dominate channels. This is a very important thing to look at when you start to dominate even a single channel, even if you're not very large. But if, let's say, I dominate Zepto, for instance, and have, let's say, 30% category share in Zepto, in whatever category you look at, I think it's a brilliant playbook to go with, because then it shows that consumers in a particular platform are using you, and these are channels which will potentially grow quite exponentially even as you move forward, and thereby you can grow along with them and so on. Okay, this is interesting. Let me just, so I'm personally an investor in Zepto, so I have biases, so please take that. But the value of e-commerce in India is around $400 billion. Yeah, so let's say Flipkart value is 100 billion. Amazon should be at least 2x that value, 2.5x that value, so $250 billion Amazon. And other e-com guys put together, maybe another 100 billion. So $400 to $500 billion is the value of e-commerce in India. The value of quick commerce in India is $20 billion. Zepto is 5, Blinkit is 6, 7. Everyone else put together, let's assume another 10 odd. So $20 billion is the value of quick commerce in India. E-commerce is $400 to $500 billion. If I look at our portfolio, and we've invested in 60 businesses across the life cycle, right from the day I started 6 Sense till now. Almost all of them do more business with quick com guys, or they do equivalent business right now with quick com guys than what they do with Amazon, Flipkart. Which fundamentally means that consumer businesses or consumers are moving towards quick com. That's where the adaptation is. E-com fundamentally will stay static or decline. Then the values should also migrate. So if the value of quick e-com is 500 billion, that $500 billion either remains there, but quick com goes up from 20 billion to maybe 100, or these guys go down from 500 to 300 maybe, and quick com takes that value. So either side. I think if consumers are moving there, channels of distribution are becoming relevant, that's where the value should reside. I think a similar thing for consumer businesses in India. Unilever right now is around $60 billion broadly. Unilever controls around 11% of wallet share today. Yeah. So let's assume, I'm just putting in a number. That means the consumer businesses in India are worth $600 billion. Yeah, 10% for Unilever, let's assume the balance and so on. Now, if that is the legacy business value and they are not growing, and I can almost underwrite that, I'm fairly blatant about this, but I can just underwrite that none of the legacy companies in India, in consumers, will grow more than 7% volume. They just don't have that ability to grow. They are still obsessed about market share gains and losses, which means that if Unilever is operating in cleansing as a category, which used to be soaps, and they keep talking about the fact that they have got a 58% category share in soaps. And Rohit will talk about this to analysts and investors, saying that 58 has become 58 and a half. So they've cracked the code, market share has grown. But they lose purpose of the fact that wallet share has moved. So people have moved cleansing from soaps to face wash, face scrub. My daughter does not use a soap, right? So you will move grade. And in those categories, their market share is not only in 15%. So while you protect market share, you lose wallet share. And that's where the growths are happening. And that's why I can't see legacy businesses growing more than 7% volume, because they are operating in businesses which are fairly penetrated and so on. So a Colgate trying to do a 12-hour brushing, they've been trying to do it for the last 15 years. I'm not too sure what they've done to change the way. So I think it's going to be a very, very long haul for legacy businesses to shape up. So the values that one looks at, I remember as an analyst, as a consumer guy, I would be reaching out to investors and talking about how 15 to 20 times profit multiple is great for consumer businesses. You should look at it. Today, all of us who are in the sell side justify a 5 to 7x revenue value. There's no conversation on profits, right? People talk about revenue multiples, which is bizarre for a business which is not growing. So I think there's a big changeover which we'll see in consumer businesses as you move forward. And just one more part, I think, when we say consumers, all of us tend to relate to only brands. I think consumers is also the ecosystem of creating consumers. So it will mean manufacturing, supply chain, distribution, logistics, warehouse, MRO, and so on. So the entire ecosystem of consumers, because as brands get disrupted, so will the entire ecosystem of the brand. So, I think that's a big opportunity that one would look at, and that's where Sixth Sense fundamentally is looking at investing and so on. I'm a big fan of Bollywood, like I'm sure all of us are. So I've just put up some snippets.
मैं उड़ना चाहता हूँ ना, दौड़ना चाहता हूँ, गिरना भी चाहता हूँ, बस रुकना नहीं चाहता.
This is what most new age companies do, right? I think all of them almost have unlimited ambitions to what they can do and so on.
शाबाश जवान दी मुझ
करना क्या है?
करना क्या है? बस बॉल फाड़ और सांड की तरफ गोल पोस्ट की तरफ भाग.
बस.
मेरे सांड को पकड़ के तो दिखा.
This is my favorite clip. Frankly, I almost use it in all presentations. What this is about? It's about how, here you have Akshay, who has no no knowledge about how to play rugby. But he's told that the only way to play it is actually just hit the finishing line, right? That's what he's trying to do. So you know the end goal. I think that's precisely what entrepreneurs of today will need to know. They may not know all the, they'll not have all the whistles and so on. But if they know where their end journey is, I think it becomes very, very easy to navigate and reach there. Because the ecosystems also become very powerful, unlike before, where I think the ecosystem was a closed door market. I think now it's become very open door. So I think as long as you are very clear about your objective, I think there's a long, long way to reach in your journey. Sorry.
और मुझे जिंदगी बड़ी होनी चाहिए, लंबी नहीं.
So Malin also made one very beautiful comment so she said that, and this is very true for a lot of people who might be in the markets, she said that if you can't handle me at my worst, you're sure as hell don't deserve me at my best. So, yeah. I'm just ending this with, I don't know how many of you have watched Scam? Very few, not enough. I think believe me, take 5 hours, right from start to finish. Please see this for guys who've not done this. I still do it. I would have possibly watched it 10 times. I still do it. It just gets me to keep thinking of, I don't think there's any better education if you are going to be in investing world than watching that movie and actually starting to read imprints of that. It's not about what Harshad Mehta did and so on. It's about how markets are, how things change, how you need to change, what are the rules of the games and so on. I think it's very, very important to look at that. So I've just picked up some snippets. Have a look.
हर्षद के धंधे की धार पे भरोसा रख, अच्छों की कट जाती है इसके सामने.
Look at the headlines here, please. So don't focus so much on what he's saying.
देखिए, कुछ लोग शेयर मार्केट में किस्मत में विश्वास रखते हैं, पर मैं किस्मत में नहीं, कीमत में विश्वास रखता हूं. लाला, ओल्ड स्कूल हो या न्यू स्कूल, सबके सिलेबस में एक सब्जेक्ट कॉमन होता है, प्रॉफिट. और वो मेरा फेवरेट सब्जेक्ट है. बॉम्बे यहाँ सब बदल जाए पर दरिया वही रहे. तो भाई मैं दलाल स्ट्रीट का दरिया हूं. अरे बिजनेस में सैचुरेशन आता है, दिमाग में थोड़ी आता है. वो तो चलता है कि नहीं.
भाई कायदा समझेंगे ना तो ही फायदा है.
लोचा लफड़ा और जलेबी फाफड़ा, इसे गुजराती की लाइफ से कोई निकाल नहीं सकता.
भाई डायलॉग बाजी ठीक है, लेकिन इसमें बहुत रिस्क है.
रिस्क है तो इश्क है.
Thanks so much.
Thank you, Nikhil, for an exhilarating session. So I just have a couple of questions and then we'll open to the audience. So you talked a lot about how you enter stocks and how early you win. And I was looking at your portfolio also. So one thing you didn't touch upon is what's your sell discipline. I saw a couple of, like on your website, some companies which you have sold, they have also done very well, like Ethos and you're mentioning. So can you tell us something more about that?
So, I think investing is slightly more easier. So when I'm looking at investing in a business, and that's been my thumb rule since I've started life. So I started in 92 when equity markets were not evolved in India, so Harshad Mehta actually just started that time. So whatever one learned was pretty much on what one felt is the right way to do it forward and so on. So whenever one is looking at investing first, for me the thumb rule is that, if I like a founder, I want to invest in him, can I sell the same business to him at 2x the value at the same point in time? Can I convincingly sell him at 2x the value and make sense? Then I think I've got the right value. So I need to optically still feel that I'm already possibly at 50% more than what the inherent value of the asset can be and so on. Selling is tough. Selling is also about a few parameters that you'll have. Like, for us as a fund, it's very important that we return money back to investors. 70% of the funds, ironically, in India have not returned money back during the tenure of the fund, right? Because it makes sense for fund managers to keep elongating a life cycle because they make management fees and so on. We'll not do that. We'll never do that rather. So I think it's important to also create a discipline about selling down. There will be something on the table, and that's how next investors come in. So we'll leave something on the table, which might be there. But you also have to sell it down when you feel it's optimizing your gains. So I think it's perfectly, so like we've sold out some assets, which possibly in hindsight look that we've sold maybe a bit too early. We could have held on for a longer period of time. But if I did that, then I think there would be too much difference between what we've done and done for all our investors to what possibly anyone else would do. So we can hold it till perpetuity, but that's not where our zone is. Also, let me just say one more thing. I think I personally think that business life cycles are really turning short. So if earlier successful business life cycles used to be 40, 50 years, incrementally, successful business life cycles are not going to be more than 20, 25 years at best. Very, very few outliers who will outlive the journey. So for us, in my mind, again, I think that if founders' life cycle with their own businesses is going to be 20, 25 years, then my life cycle with the founder can't be more than 1/3 of that. As an investor, my fiduciary responsibility is to obviously invest, hopefully grow the business with them, monetize, invest again. So we'll take that call every time.
Great. And just last question from me. So you said that for any brand, the best time to enter is that when there's a 100% category share, and then they can get 20% distribution through all these quick commerce players and e-commerce. So now has value migrated from all these big brands to quick commerce, and they will command the high market caps and not the consumer companies like HUL and Godrej?
Oh, completely. Look at globally. The brands that we all look at. I don't know how many of you guys are tuned to the market, but maybe the last 1 year, prior to the last 1 month, when markets were in a decent position, you would have seen most of the multinationals actually selling down their holdings in India. So Whirlpool has actually sold out their asset in India because they want to fund Whirlpool Global. And believe me, there are so many temptations of so many companies actually selling down their business, right? There are so many businesses which are getting sold out by global operating businesses because they just think the values are just bizarre, to say the least. And I forget your question right now, sorry.
Distribution versus brands.
Yeah, so you look at globally, right? Globally, all the brand companies, right from your Unilevers, Nestlé's, or whichever you look at, all of them quote at 20 times profits. They don't quote at 70, 80, 100 times profit. So they quote at a very reasonable value multiple for making a 25% ROI. In India, consumer companies make 80, 100% ROI. You're leaving just so much room for someone to come and not kill you, but at least have relevant market share. I think they just leave so much of room. So I think distribution platforms get more value. Think of it, Nykaa and Purple evolved in 2013, 2014. Yeah, that's when they set up shop. Nykaa and Purple started life saying that I will sell Lakme, L'Oreal and Maybelline and so on, right? That's what their journey was. Fundamentally, these platforms should not have existed. It should have been Lakme, L'Oreal doing this work. But a platform decided that, why sell a 15% gross margin business when I can make 75% gross margin by selling third-party brands or own brand? And that's how platforms become powerful. And suddenly you saw, if earlier, let's assume 1 million people went into buying a Lakme, suddenly you found 5 million people wanting to buy into Nykaa and Purple. So I think value migration will always be a lot more relevant, dominant and sustained in platforms than brands. Because brands can evolve. So Walmart is still a very valued company. It's a distribution platform. And so it's true for almost every distribution platform we look at. So I would, any day if I had a choice, not any day, but I'm saying almost, I would pick up the platform.
So anyone from the audience who has a question, please raise your hand.
See, what I could understand from your investment philosophy, you have always preferred to get into a category wherein there is already a leader with a maybe more than 80% market share, and you would prefer to bet on a second player, right, who could disrupt that market, right? If I look at one of your investment, right, like a national stock exchange, right, which was already a dominant position with more than 90% share, more than 97% share in a derivatives market, right? Why you prefer to invest into NSE and not BSE?
Okay. So in life, never say never. Yeah. As a fund, we have the ability to invest right from boardroom stage, which is ideation stage, to listed. That's the spectrum that we have. I prefer not to do boardroom stage. Having said that, I tell my team, we're not going to look at boardroom stage, ideation nahi dekhna. And literally within a week of me telling them and giving all this, I met a founder whom I really got completely smitten by boardroom stage ideation. And I said, "Theek hai, I'm good to invest." So that's a company called Uppercase, which is a luggage company. It's a Mokobara equivalent, if you guys might know Mokobara better. You just have to get smitten by that idea. Now, NSE is interesting. Around 15, 16 years back, again, we were the first guys in India, the only guys in India, to have worked on exchanges, when exchanges were not even listed in India. BSE was not listed, NSE was anyway not yet listed. But I've done a lot of work on global exchanges and how they will evolve and so on. So I've done a lot of work which are very freakish in nature, so it's got nothing to do with listed market, but just to get more ideation about how one visualizes and so on. Exchanges are the only growing annuity in the world. Every other annuities that you look at are static annuities. So if you look at power utilities, it's static annuity. You get 9% ROI and so on, right? It's very static in the way it is conceived. Exchanges are the only growing annuity because you have to believe that everything which is transactable will get transacted. So today it could be equity, tomorrow Forex, could be something else, commodities and so on. So it will keep multiplying, the use case will multiply. And effectively it's a growing annuity, growing business. And because it's very sticky, the same platforms exist. So exchanges are at best a monopoly, at worst it's a duopoly anywhere in the world. You can't get better than that. So unlike other businesses where there's a lot of room for other players to come in, exchanges work on the principle of liquidity, which means that if I have got used to NSE, there's no chance of me doing something on OTC, for instance, which doesn't exist anywhere. But yeah, so very different reasons to look at that, yeah. Yeah, please.
Presentation was very thought-provoking. You talked about the challenger brands. Just on the valuation, when specifically you are talking about category creation, like a quick commerce. How do you assess that this businesses will be viable because the business economics is not established just yet, and B, how do you put a valuation to that?
Yeah. 6 cents. Very tough. Let me say this. The good part about investing sometimes is that I've spent 32 years doing this work. I still don't know whether I'll go right the next day. Yeah, so it keeps you at the edge at every stage in life. So it's not autopilot at any stage, which I think is a very sexy part of the work that we do. That it keeps you alive every moment, right? Having said that, I think what are the things that you look at in investing, right? Specifically in private, when maybe a lot of things are not proven. I think firstly, on coming to an investment decision in a private business is equally tough, right? Again, like I always think, you have to strip off a lot of imagery. You have to get to a very focused way of looking at things. So I look at only 3 things if I have to invest in a business. There are maybe 300 other things which maybe I process parallelly, but 3 things that one would look at. One is whether I like the founder's face. Very, very important. I need to like the founder's face, which means not just the face. It means that I can go along with him for the next 7-8 years. I think he's extremely credible. I would want to believe that I can have a drink with him 10 years later. I think he's 6 months ahead of the curve. Now, these are all optics. It's all qualitative. It's got nothing to do with what he may have done, not done. It's our visualization of how I think he will be. Very important quality, but I think the more you keep meeting founders, and I've possibly met 3,000 founders in my journey, the good, bad, ugly in India, or whatever you can think of, right? Everyone. I think you get that. In some form, hopefully you get it. You still don't get it sometimes, but majority, I think, almost always get it. So that's a good part. So founder is important because also it's very important to know that what you choose to invest in today, and specifically in private, what I choose to invest in today will be a very different business that I'll exit out 6 years later. I think it's almost a given. I'm not a believer of the fact that today what we are investing in is the linear growth path that I will exit out later. No chance. There are just so many variables that all you want the founder to do is be 6 months ahead of the curve. So be slightly ahead of the curve to be able to manage the variables better. So that's one, founder. Second is the space has to be large. Big believer of, not a great believer of leadership in a niche, a big believer of larger market size and so on. The good part about India is that everything is large by default. I have this thing about, if 2% of India starts to consume Scotch, India will be the largest Scotch market in the world. So I think that's a very safe place to be in, that most spaces will be very large and so on. So that almost takes a tick. And third and last is whether the product has some uniqueness of its own. Now, I've said before that there's no product IP in consumers. Yeah, I stay to that. But is there something unique in the way the product is positioned to you as a consumer, to me as a consumer? So for instance, I invested in Fog, which is the Fog Deo, if you've heard. Again, very interesting. Fog was not even, it was just getting conceptualized by Darshan, by Vini Cosmetics. But what interested me was the fact that, deos worldwide, it's a very normal consumer category product, so it's not a new age product by any stretch. But deos worldwide were getting marketed saying that you put on a deo and 10 girls chase you. People get attracted to you and so on, right? That's how deos get marketed everywhere in the world, yeah? This guy said that, I want to think differently. You put on a deo and you get more spray per deo, which fundamentally was a fantastic breakthrough, because what it did was that he didn't oversell the virtue of a deo making you smell good. It's a given virtue of the product. Why oversell that? By just having someone more, it just didn't make sense, right? So he said, okay, I give you more spray per deo. Fundamentally, he told the consumers that other guys are cheating you, I'm not. I'm giving you 80 spray per deo, someone else is giving you 60 spray per deo. Brilliant marketing. So what that product attribute was for a consumer was very different. So I think if we get these three elements right in our mind, we are mota good to move. Other attributes aside here. Yeah. Okay, let me share this. It's important you brought this up. So I did say that we lost money in 3 businesses out of 60 that we invested in. Ironically, we invested in the first quick commerce company in India, a company called Frazo. A lot of you guys may not have heard of it also. Yeah, it was in Mumbai and Pune. Yeah, Atul. We're the first investors in Frazo. And this is 4 years back, not too far. We've lost money in that, by the way. Yeah, we've lost money. My thought was that instant gratification will become very large. People will want it today. I thought we got the right guys, brilliant guys from Asian Paints, doing extremely well and so on. We got the right guys. We backed the right guy, right space, and I thought a category which we thought was going to become very relevant and dominant. We lost money in it. So, and ironically, if that portfolio had stayed put, that single investment would have recovered the entire capital back of the fund. We made it 0, by the way. That investment was 0. So sometimes, like I said, we want, the first guy through a door can also get shot, right? So sometimes you are just slightly early in the, no, more than slightly early in the journey, you'll get shot. So you have to take your chances. Now, how do you value these assets? Very tough, yeah. You have to believe in certain cases what that business can become with your capital in the next 3 years. Can it become a very non-linear outcome for what your investments are? Are you in a position, and we do this, right? Are you in a position to operationally get involved with a lot of attributes in the business? We are very involved investors with all our companies, excluding NSE. We are involved with all our portfolio companies because we think we understand this. हमें लगता है ecosystem है हमारे पास. We can cut short a learning period for founders and so on. So I think if we think with our ability, we can kickstart a business better, faster, and thereby the values come in much earlier, we'll be happy to do. Values will keep differing from every business. So very tough to say it. The fact that we've not lost money in 57 out of 60 means that we invested at the right price, right time. So we're okay with that.
Just an extension to that quick commerce thing. You mentioned that you prefer platforms. You said you prefer platforms to brands, but for there is no loyalty for brands. There is no loyalty for platforms at all, right? Now the point is, because I mean, so if you say a cab booking app, right? There is an app that comes every 1 year, then grabs market share, right? Now the thing is, the profitability metric of say a new platform is not set, right? So if brands are not, there is no brand loyalty, there is no loyalty to platforms. Right? So how does that work?
No, tough one, obviously. When I say I prefer platform versus a brand, doesn't mean that I'll not invest in brands. We'll obviously figure out guys who will be a breakout and so on. And so far we've done a decent job on that. I'm just saying if I had a choice between just these two animals, right, I'll prefer this animal more. It's tougher to create a platform, much tougher. When brands can get created because there are just 15, like I keep saying, there are 15 layers of distribution that I need to crack, easier for me to do it. I know Zepto, I know Blinkit, I know Amazon. I can very easily place my product there. You could do it. And I'm not kidding, you could do it today. You can start to sell a bag. You'll get your listing in Amazon. Very easy to do it. Not a big deal. Try and create a platform like Nykaa or Purple. Tough. Try to create a platform like Policy Bazaar. Tough. Try to create Zomato, Swiggy. Tough. PayTm was tough till UPI came in. So there are obviously risks in everything that you look at. When fundamental thesis is that business life cycles are going to shrink, your agility will become a lot more important also. So you also need to be agile as an investor. So I'm not saying anything is for keeps. I run a consumer fund, but I genuinely believe that brands are not forever.
Achha, I have another question, right? As an extension that you talked about a lot of investments, right? If you could highlight maybe your top 5 anti-portfolio which you missed out and have some regret, or even if not regret, something.
What we've not invested in is for fair reasons why we've not invested, so don't regret anything. I genuinely don't. And I'm not saying it as a statement. It's perfectly okay. Let's say we did not invest in Aman, in Boat. By the way, Aman invested in us, so that's okay. But yeah, we didn't invest in Boat. I felt at that point that Boat was a trading business very early in their journey. They were doing trading, and mujhe laga it's not a big deal. There are a lot of businesses which do trading, get it from China, sell it in India. Not a big deal. I think where we missed out now in hindsight, could be, not in hindsight, but frankly, it still is a trading business, by the way. But I think the fact is that the market opportunity was extremely large. And it was just coming at the right time when digital penetration, mobile penetration was just going up. And you could have, it could be Boat, it could be Apple, or it could be whichever other brand that you can think of. Everyone would have done very well at that point. We are just not convinced about the longevity of a business like this, where it's a trade-in portfolio. So not really a great fan of that. So we didn't invest. But you will, at that point it has to make sense. I'm not too sure whether we've really regretted. I think the 3 investments you have not done well, ironically, and that to me is always the good thing that I look at. I still feel that I should have invested in all those 3 investments. So I feel very happy about it. Which means that it's not that, like I said, first guy through a door gets shot sometimes. Sometimes businesses grow so well. We invested in Smash, we lost money. Yeah, Smash is the center of the city entertainment. And it's Shipal Bhai's company. Shipal, I used to work under Shipal Bhai 20 years back. So loyalty bonus did not work. But I thought it's a brilliant model. We were doing so well. We thought equity in this business will become very expensive because there's nothing like this anywhere in the world. So if you want to do, in India there are only 2 forms of entertainment. One is movies, and second is fine dining. Fine dining died before it arrived, so it's only movies. And we thought this is super sexy. So India is not Orlando, so not US, so people don't go to Orlando, people don't travel. We don't even go to Imagica, which is 1.5 hours away, right? So I thought this was super, which had something for me, for my kid, for my wife, for my parents and so on, which looked very, very good. And it's a frequency event because it's center of the city. And we were doing so well in Smash that we said, okay, let's grab more spaces, move fast. We went to US, we set up shop. We went to Dubai, we set up shop. So we went global because there's nothing like this globally. We thought we'll do a NASDAQ listing, didn't happen. And then COVID happened and it just crashed out. Because we grew by way of debt and not equity, because we thought equity will become very expensive there. So you'll take that chance. Sometimes you will fail because you're too early. Sometimes you'll fail because you've succeeded so well that you think you have a case to become a bigger outlier when we are. We'll take the chances. We'll still have our learnings on this every time.
Yeah, Nikhil, fantastic presentation. Thank you for that.
Thanks so much.
Question on, those consumer companies specifically, and since you've also interacted with the global boards, so, so whether it is a Unilever, Nestlé, Coke, they have they have very high quality management talent. So my question is a bit more philosophical, and personally I'm quite heavily invested in this, so there's a personal bias also, that why are they not being able to really see this disruption?
Yeah.
I mean, theoretically what a Nykaa could have done, a Unilever could have done it, in maybe a few months.
Yeah.
So I'm saying fundamentally, and since you've interacted with their boards, what is missing? And and given their very high quality boards, high quality management talent, and is it, and from any of them, do you see that they are likely to get more agile going forward?
No, I think brilliant question. I think one is that unlike in the past, the new age entrepreneur, the entrepreneurs in the last 10 years that you see in India, there's a very different quality that you need. So entrepreneurs earlier, let's say 2-3 decades back, needed to be great thinkers, and they'll get execution teams to work with them. Entrepreneurs today have to be great thinkers, and they have to be great execution guys also. So it's 2 roles in one. So which is very, very tough for most companies that you look at. Legacy companies, let's say Unilever, for example, and Unilever is by far the finest consumer company in India. I'm extremely negative on them, but it's the finest company. I think, the challenge for most of the established, and Unilever is symbolic of the consumer companies that you look at and so on, legacy, is that there is no brownies that they get for cultivating a startup business. So Sanjeev, who was the CEO of Unilever prior to Rohit coming in, Sanjeev would meet up once in 6 months for lunch or dinner, only to send a message to the team that I'm spending time with Nikhil. Technically, I'm spending time for the next 10 years of what potential businesses will look like. You guys start to do it. Very tough to move them because their systems are such that you are moved up every second, third year. So can I do the regulatory things and do better and move up? Or should I try to risk my career by trying to create seed a startup idea, and which may not see the complete longevity, because Unilever system you will get lost. It's not going to move the delta anywhere. So very, very tough for larger companies to do it. Companies like a Marico or a Dabur, which are slightly more, not even Dabur, Marico or Godrej for that matter, should be able to do it much faster. They are at least ownership-driven businesses in some form. So they may be able to do it slightly faster. Unilever is by far the best in consumer business in terms of actual management talent and so on. But they are organizations, so they move in a very graded manner. So they will remain in existence for the next 50 years. But will it create the wealth that all of us as investors seek to have? That I think will be challenged.
Yeah, thanks Nikhil for the insightful presentation. So I actually have one question which, something which I've observed, I could be wrong. But if you look at the consumer behavior in India, right, is it true that we are preferring, separate apps for different categories vis-a-vis one app all solution? So the case study which I'm referring to is, let's say, Zomato offering food delivery, grocery, quick com in separate apps vis-a-vis say Swiggy, or for that matter innovative retail where everything is clubbed. it seems that our behavior is towards separate apps, or there is some different thing that I'm missing and it's more about some execution or positioning aspect from these companies.
No, I would as of now agree. I think this one app concept which a lot of players have tried, Reliance tried, Tata's tried, super app, yeah, has pretty much bombed. I don't think that really exists anymore. Consumers, I think somewhere they've got used to who are great execution guys in various specific businesses. So to have one mother app or a super app as it's called, which will service every need of yours, it's a bit of a alien concept. I think it's very territorial also in some form, saying that if I'm Tata, I know every business in this country and I'll crack it better. Tata Click will service what a Nykaa can't do and so on. I think it's too much of hallucination that you are in. I don't think that's going to happen. So I think it's important that in each vertical, if you are extremely strong, you need dominancy in vertical, and then you can scale up a couple of other things. But if you try to create a mother app and say that I've got everything with me, now come on me, that's very, very unlikely. So let's say someone wants to book a ticket and PayTm also had book my whatever, something. Yeah? But people didn't go to PayTm for booking a ticket or a show, right? They went to book my show. So I think it's very important about how people execute in each of these vertical. In India, it's still very nascent stage of this entire evolution of multiple options and thereby consolidating it and so on. I doubt whether it's likelihood. Yeah, no. I don't have too much insights on that. Sorry, you said globally there are, but globally markets are very, very different. We keep thinking that India should become what US was 10 years back, what China was 5 years back, and so on. There is technically no quick commerce in US. It's very, very small. There's no too much of concentration of people and so on. It's not as prevalent as you possibly will always see it in India. So tough to draw analogies there.
Hi Nikhil, I'm Rohan. I studied industrial engineering at Northwestern and then worked in New York for a few years. I just moved back home last year to build an eyewear brand because I felt that was a space where there hasn't been much disruption, there's been no innovation. So I plan to build a premium eyewear brand and make it accessible. I want to price my products at 4,000 to 6,000 rupees. So what advice do you have for me?
I want to build a premium eyewear brand which is affordable. Okay. I didn't quite get it, but anyway. I personally think that, okay, there's another, so some of the businesses which might look very interesting, and it would be stupid for me to comment on a business like this upfront, so unless I really understand. But I think, you have to also look at around you. So businesses which have never shut down shop. I invested in a company called GIVA. GIVA is a silverware company. They are a Tanishq equivalent in silver. Only for that reason. I'm not a great fan of jewelry as a category. But I love the fact that I've never seen any silver shop shut down, ever. Yeah, so I said, this is super sexy. We'll figure it out and so on. And it's done brilliant for us, super brilliant for us. So the business was 5 crores in monthly revenue, only online, 2.5 years back. It does 50 crores monthly, set up 190 offline stores in 2.5 years, which is crazy pace of execution to be done. We invested at around 225 crore value. The last value is 3,500 crores right now. Done very well and so on. Beyond the value, I think it's about how you pick up businesses. So spectacles is another one, eyewear is another one where, frankly, eyewear guys make a lot of money, individuals. Forget about how they make it, but they make a lot of money, right? So there's a lot of money in this trade, which means there's a lot of margin, which also means that in India, that's also a fact that anything which is extremely mom-pop driven will over a period of time get consolidated. It will move towards non-owner businesses. So like retail shops are owner-driven businesses, so you have relationship one-to-one. But I again can't see that sustaining over a period of time. Like maybe I have my GP, my doctor who's very close to me, he's my age and so on. But I can't see my daughter having a similar, she will possibly go to private clinic, she'll go to a hospital if she needs to, and so on. So I think that trend change will happen. It's happening in jewelry, it's happening in almost every space that you look at, will happen in eyewear. It's already happening, right? So you look at what Lenskart has done, what Tata has done. So I think it's an interesting space to be in. Price points, everything, I think, it's looks, what you say looks and sounds very good. So you move away from, you actually start to position Lenskart as a poor man's eyewear and start to move up a bit and so on. Could be a very interesting space. That's all I can say right now. I don't have enough. Yeah. Okay. Maybe a bit of that, but I think what would be very interesting businesses, and it's already happening. So the irony in India is that what we think is virgin gets so I'm sorry, I'm using these terms, I hope it's okay. Yeah. What looks virgin right now gets overexploited very soon. Yeah. So frankly, India mein aisa nahi hai ki you think that, oh, I've cracked a niche and no one else is there. In 6 months, there'll be 10 other guys who will do the same thing, right? So very, very clear, that will happen. So I think what will happen, or what is happening as we speak, is that all of us, and I'm saying this as the last generation in some form, I hope I'm not yet, but we are very poor readers. We were not label readers at all. I think the next gen is a super label reader. So they read content very, very well. So if they buy a footwear, I'm not wearing Neiman's, but we have a stake in Neiman's, which is a footwear brand, which is supposedly the most sustainable footwear in the world and so on. We're obviously changing that and saying most comfortable footwear is a better way to go. But I'm saying that, or a Russ luxury beauty product business, which impacts you, or a uppercase which is made on sustainable products and so on. So I think sustainability in different layers will become a very important read. So it could be in organic food or in generic, I think. The only thing that we need to watch out in such cases is that is the supply chain of what you plan to do efficient enough? A lot of things in which is good for you or better for the world is not great in supply chain. I can tell you with live example, Neiman's was a very good example. It started with sustainable footwear. We did plastic bottles and so on. And then after a couple of years, we figured out that actually it's starting to hit us a lot more, because while consumers were getting converted, but let's say if 10% of the consumers felt that sustainability is the way to go, they were buying Neiman's, but 90% didn't feel like that. They were not attached to that cause at all. The irony is that when the 10% were buying it, my supply chain had to become super efficient, because I needed to have 3-month supply chain efficiency here, which was not possible. So if I have to be in fashion business, which has to rotate, it was becoming a stumbling block. So we said, okay, let's now, well, we've already planked ourselves as sustainable, which is true. It's better than anyone else. Let's go to the most comfortable footwear. It's a better positioning. I can change my supply chain better. So you'll have to figure out in which positioning you are in. But yeah, anything which is better for you, good for you, is a great business to be in, because I see this as a track for every new product introduced in this country, from legacy companies or from new age companies. It will be better for you, good for you, by default.
Hi Nikhil, I'm Vashaki.
Hi.
I actually work at one of the companies you invested in, Incred.
Which one?
Incred.
Oh, lovely.
So your presentation had a couple of clips. There was one with Akshay Kumar running frantically towards the goalpost, and Bunny saying, "Main udna chahta hu, bas rukna nahi chahta." And also Harshad Mehta mentioning profit is his favorite variable. So what's your stance on the whole growth versus profitability debate, and is it just about timing, or are there any other nuances or considerations?
So I think it's important to figure in which part of the journey one is in. So if, let's say, if I had a ability to be like SoftBank, and it's not negative at all, I'm just saying if I had the ability to cut very large checks, then I would want to change the world. Yeah. So then I have the ability to say that I'm going to fund one guy so disproportionate, because my belief is so large that I'll keep funding him for the next 10 years, which will also mean that I'm overfunding him today, I'm overvaluing him today, and I'm also ensuring that no one else will ever fund anyone else. Yeah, so I'll become the singular player in that category to drive consumer habit change or behavior change in whatever form. So if I had that ability, I would love to do that, because I genuinely think that maybe we hopefully we'll have that ability to think differently and thereby invest businesses accordingly. By default, I don't expect them to make money, because if it's about changing habits, it's a very, very long drawn affair. Indian consumers, if I look at palate also, which is our taste buds, we are a very difficult animal. We don't change our taste buds. So if I don't like Japanese, I'll not eat Japanese, period, right? We are not like Americans and Japs and so on, who are very adaptable in their taste buds. We are not. So if I have to change taste buds, then I have to go to a Subway, McDonald's, Pizza Hut, and then figure out what a Southwest tastes like or a mint mayo tastes like, right? That's how a V-bar got evolved. They did B2B first before they did B2C. So if I had that ability to do it, put larger checks, I'll go for the option of saying that, okay, let's change the world. Let's make it impactful, and maybe the outcomes are going to become extremely great and so on. And that's how a lot of businesses have grown. So Oyo, what you see today, and all these guys are very close friends also, Oyo, PayTm, we may debate whether it's the right value or wrong value, but the fact is that we are habituated. Zomato and Swiggy and Ola, whichever you look at, right? It's all been done because disproportionate capital went into those businesses to create that change. Now, from our perspective, for us it's critical that we strike some bit of balance somewhere, that does our capital ensure that the business will turn profitable, if it's not right now. I think that's one standpoint. So I don't want to wait for the next layer of investor to come and then fund the business to make it profitable. That is not our ideal mode. So I think if our business, so I think if there was choice between profitability and growth in consumer business, I would say that as long as the businesses do less than 10% losses, I'm very, very happy in a consumer business, because consumer business to make money is very easy. It's a 55-60% gross margin business, 50% plus gross margin business. So if I have to change the tap from a 10% loss to a profit, all I have to do is figure out how to improve my realization by 3-4%. That's it. Not a big deal. If I've got scale, I've got frequency of customers coming in, product accepted, market fit done, then to do 3-4% is not a big deal. So if I had the choice between the two, I would say, okay, let's push for growth within that 10% band that fund looks at. But if the band is going to be 25-30% negative, I'll say, guys, let's go closer to 10 and then figure what that journey should be. So it'll really be a mix of both somewhere.
Hi, Nikhil.
Hi.
I'm from Mata Ventures actually, so habitual to the VC space. Two questions I had actually. One was, am I audible?
Yeah.
So one question was, given the choice of selecting between idea and the execution, or let's say idea and the founder, which one would you go for?
Founder any day.
Any day, over idea.
Ideas are dime a dozen. Again I say this, every fifth guy in India is an entrepreneur in his mind. Right? So there are ideas which are there for all of us. I'm sure if I'm so engulfed in 6 Sense, but I'm sure if I get even half an hour, I'll start to think of 5 other things that I can do in life, right? Beyond and more. So idea is not a great thing. I think it's about founder and thereby the execution that the founder and the business can do. I think that's always going to be your killer.
Okay. Thanks. And
for every great business, there is a failure in the same business. So Melora failed, and you saw Tanishq and GIVA, Carrot Lane, Bluestone do fairly well. So it's always going to be founder.
Yeah, one more question is, how did you do the DPI in 2.5 years return? Like, what was it? Like, because that's a very short cycle in the VC space as well.
Oh, it's a obnoxiously short cycle.
Like, I would say it's impossible, but...
Yeah, I agree. I tell all my investors also that don't expect this to repeat itself. So just for people who don't know this, we return 100% of the capital back. So our funds are 7-year tenured. We return 100% of the capital back in 2.5 years, which is bizarre. By the way, it's supposed to be very good, by the way, just in case you didn't realize. Which is bizarre. No one does this. No one can do. Very few people can. No one has done it so far. But frankly, I guess we turn lucky, hopefully. So frankly, whatever we invested just moved up very, very sharp and so on. So we were able to monetize much faster and so on. But yeah, I think that's not normal. Lots. We had one investment in a company which became 7x in 1.5 years. We sold it. We have, in that portfolio, we had Ethos. We had invested at $80, which has done phenomenal, which is a luxury watch retailing company. We had Hindustan Foods, which we had invested at $8. which is worth quite a bit. It's grown 100 times and so on. A lot of companies. Frankly, everything did well. So, yeah.
Hi, Nikhil. Thank you for your time today. I'm Manav Choksi. So, because you've invested in the public space, in the public markets, in the consumer space, what were some of your learnings that you had to change when you moved into like the consumer space in the private, in the VC sector?
No, I think the reason why I moved to the private space in consumers was because the belief that consumers and listed will do nothing in life. Simple. Learning, done, executed. And I genuinely mean it. Like whatever we are doing, it's not incidental in some form. Ironically, it looks far more sharper where Sixth Sense is today or how we have evolved. But when one did this 15, 20 years back, right, and one started to keep building up thesis, I think a lot of things that one reflects back actually happened because of how one was thinking 15 years back. And it comes into pieces, right? So somewhere we've been, I think, we've been okay. We've been pretty okay.
So we've almost run out of time. In fact, we have exceeded it. So we'll be closing Q&A formally here, but we'll be having dinner outside. You can ask questions there also. So I'll just close with a last small question for the benefit of the audience. A lot of people would admire your success, your career, and would want a career transition into venture capital. What will be your advice to them?
So, okay. So my daughter is 19-year-old, the elder one. I have twins who are 9-year-old, so a lot of kids at home. She's studying in US right now. So when she was in her 7th grade, I would ask her, what do you want to do in life? And she would say, Papa, I want to become a doctor. I said, chalo, good. In 8th or 9th grade, I asked her again, and she said, Papa, I want to become a lawyer. I said, okay. In her 10th grade, I said, what do you want to become now? She said, I want to become a supermodel. I said, fundamentally, you don't want to study. So I think, I personally think, and obviously I have a father's bias, I think she's very affable, which is a character required in what work one does and so on. People need to feel very comfortable about you as a person, and then I think she's very good at that. I used to keep telling her, be in the profession that I am in, not because I am in it, but I genuinely think that's what you'll really love. And she was very, very sure that she'll never do this. Last 6 months, I am only hearing her saying that, oh, Dad, I saw you here. My friends showed this clip or whatever, something else. And she's getting excited about this. I think it's one of the finest professions that we can be in. I started it when there was nothing like this. 92 had, there were 2 broking houses in India at that point, which was Lloyd's Security and SSKI. These were the 2 broking houses in India, 92. So no one had done any research in life. So we just evolved, grew along, created our own way of growth and so on. But I think today, all of you, I say this to my team also, by the way, this is possibly the only profession. I'm not saying VC, I'm just saying investing, research, whatever you guys end up doing at some stage. This is the only profession where you can go 50% of the time wrong and you'll still be a rock star. Imagine an engineer who's constructing a bridge if he screws up. Imagine we go wrong half the time, we'll still be fine. So if you're, other thing is that, if you think yourself to be slightly better than average, I think this is a great profession to be in. The irony is that, the fact is that it pays you very well, which I think it's on us to actually monetize also. It's all fair, we should. It pays well. You meet the best and worst of founders in this country. You have access to everyone, right from Mukesh Bhai to everyone that you can think of. You can meet them, which I don't think any profession in the world will allow you to do that, right? You stay in the best of places, travel well. And I think the most interesting thing is that you meet a founder for 1 hour who spent maybe 20, 30 years doing that business. And in 1 hour, 1 minute, you think you are smarter than him. It's crazy, and I'm saying that frankly. I meet founders, I'm slightly differently wired. I don't do too much of pre-work before I meet the founder. I want to go very, very raw, very, wrong term, naked. I want to have my mind completely blank. I want to create my impression as I speak to the guy. So I don't do pre-work. My team does it. Everyone does that. I don't do it. But it's important that And ironically, while the founder speaks, I'm already thinking of his business. And before he finishes, I've already figured out what I think the business should be. And I'm telling him this. And the irony is that the guy who spent 20, 30 years actually listens to you. So you can't get a better profession than this. Obviously, you have to work hard towards this. It's so interesting that, all you guys, I'm presuming all of them are CFAs or going to become CFAs. I think it's a great journey. Think of it, every engineer, every IIT guy wants to be in finance. Every guy in whichever space. So when we put up a LinkedIn post saying that maybe we are looking at someone, we get 1,200, 1,500 resumes coming from IIT IIM guys, Bain, McKinsey, and so on. Everyone would die to be in this space because it generally is great. And so if you get a break into it, please do take it, but do make a very, very good job of it, because it can kill you also. It can kill you if you think that you're not half as good as the next guy in the space. It can really demoralize you. So after a point, money will not make a difference. It's about your ability to see that, okay, I'm actually doing a great job. If you don't feel satisfied about it, then frankly, there's no space for you. You shouldn't be in the space. I'm just very, very critical about all these things. I genuinely think so. So if you think you can be better than average, please do this. If you think you're driven to do this, please do it. But if you think you're not and you're just doing it because your friend did it and he's earning more money than you, then it's not worth it. Don't even try it.
Thank you, Nikhil, for a fantastic session.
Thanks, guys. Thanks so much.
So now may I please invite Mr. Litesh Gada, board member of the CFA Society, to felicitate Nikhil with a small token of appreciation. So thank you, guys. We can proceed to dinner, and you can continue your question and answer with Nikhil in the dinner session as well. Thanks a lot. It's been a fantastic